The Monetary Policy Committee of the Central Bank of Nigeria, for the first time in the year 2022, will begin its two-day policy meeting. The meeting has started already, of course, with all indications pointing at the retention of the existing monetary policy stance. The 10-man committee, headed by the CBN Governor, Mr. Godwin Emefiele, last met in November 2021, voted to retain the monetary policy rate, which is the benchmark interest rate at 11.5%. The asymmetric window at plus 100 and minus 700 basis points around the MPR. The liquidity ratio at 30% and cash reserve ratio at 27.5%. For the record, the MPC has maintained the status quo 25 times in the last 28 meetings, and the recent unexpected surge in inflation could be the pedal, mounting pressures on the monetary policy authorities to possibly hike rates tomorrow. However, going by the movement in economic indicators, economic analysts are of the view that the Apex Bank will leave its policy unchanged at 11.5% for the next 2 months. Well, let's get to understand this and analyze it properly. I have joining me via Skype is the chief consultant at B. Adedipe Associates Limited, Dr. Biodun Adedipe. It's really a pleasure to have you join us on the show today, Dr. Adedipe. Good morning. Good afternoon.
Good afternoon, Tolu. Thank you for having me. Pleasure being here.
Yes, and I think it's the first time we're having you this year, so I think it's still right to say Happy New Year to you. Yes.
Yeah, thank you. You too.
All right. Let's start this conversation because I'm thinking that there will be a lot in the plate for the committee to chew today, talking about inflation that is now on the high side, a lot of projections and reprojections that we've had. I will let you as a professional take us through what do you think will really give this committee that headache today for them to come up with decisions that we expect tomorrow before we now go into them maybe one after the other.
Okay, thank you so very much. I think the first thing to ask ourselves is where is the state of the Niger economy as at the end of 2021 and currently as well. And then look at the major macroeconomic indices and the one that are of particular relevance and importance to the Monetary Policy Committee. And from there now take a position as to what will likely drive the outcome of the meeting. So the first thing to bring to the attention of the viewers is looking at the data on the Nigerian economy in 2021, officially released by Nigerian Bureau of Statistics, as at the end of September 2021. From January to September, the first 3 quarters of the year, the GDP growth rate averaged 3.18%. So, and of course, looking historically at the pattern with our economy, usually fourth quarter is when we have the greatest speed, which means even if we take the concern about the fourth wave of COVID-19 into account, which of course did not affect the business space in Nigeria, in any way we can take into account as likely to be, an adverse effect on the GDP growth rate. So then it means we likely would have ended 2021 at a growth rate of our GDP between 3.2 and perhaps 3.4%, maybe higher, depending on what we got in the fourth quarter. So that means then that the economy is growing apace in terms of expectation. The expectation of MBS for the year was 3%. Of course, first 3 quarters were above that, and most likely we ended above that. So that means the economy is going in the right trajectory in terms of growth. The other side to it is, where did that growth come from? The growth we experienced in 2021 came from the non-oil sector. So that, of course, makes it more sustainable, so to say, and also more enduring. So it then means that creates the prospect for 2022, which is now what the MPC will be looking at in terms of the decision they have to make. So the economy is growing and also expected to grow. In fact, if we go by all the projections for this year, every major, institution or organization that projects growth of the economy raised Nigeria positive in 2022. Put that on one side. Then we now go to the issues of inflation rate that you mentioned. Now, prior to December 2021, that is up until November 2021, the inflation rate in Nigeria had been going downwards. We recorded 8 consecutive downtrend in inflation during 2021. The uptick in December 2021 was not significant in the sense of creating worries or concerns as we see in the advanced countries, where, for example, a country like the US experienced inflation rates they've never seen in the last 40 years. That is not the same case with Nigeria. Okay? Now, I have a chart on this in monitor inflation rate in Nigeria. And when you look at that chart, where we saw a peak in 2020, driven by the COVID-19 impact and the stimulus package from the federal government as fiscal authorities and for the monetary authority, the central bank. Now, if you look at that, it shows clearly that we are still comfortably below that peak. So, to me, therefore, looking forward to 2022, the question will be, do we expect inflationary pressures to become so strong as to warrant a response by the MPC? I don't think so. Of course, that rate will still be double digit, quite all right, in terms of expectation, but we don't expect it to go all the way up and possibly go beyond 19% and take us to the third level of the digits. Okay? So it then means that inflation will not be a worry right now. And let me also add this to it. There's a difference when you talk about expected inflation between, one, the normal increase that is driven by economic activities and the increase that is driven by episodic pressures. So Nigeria currently is not experiencing anything that is fundamentally changing in the economy that warrants inflationary pressures on a permanent basis. Because that is what monetary authorities normally look at anywhere in the world. So we don't have that now. So inflation will therefore not be a worry. The other thing then that can come into the conversation is the exchange value of the Naira. And the question again is, what can make Naira lose value this year? When you play between the official rate, which is now the investor exporter window, vis-a-vis the roadside rate. Unfortunately, and I need to mention this, when we interpret the FX market in Nigeria, most of our analysts, they get it wrong. And why do I say that? Because the FX market has different nomenclature in the sense that you have the thin market, you have also the thick market. Now, the alternative market, which you call the parallel market, is actually thin. Being thin means the volume that takes place there is not anywhere comparable to the volume in the official market. But unfortunately, we have got ourselves into a narrative where we use the rate in a thin market to decide how the market is behaving. And we ignore where close to 90% of transactions is actually happening. So, for me, therefore, the expectation is that the only reason the Naira will lose value, that is, central bank will respond to that, is when we put too much pressure on the monetary authority to devalue the currency. Without that pressure, there's really not much basis for that. And again, looking forward to this, the interplay, we call it, between imports and exports. Yes, worryingly, our export bill in import bill in Nigeria has been going up significantly. In fact, if you interrogate the data for 2021, it shows that our import bill more or less doubled in 2021. But the question again is, what were we importing that made the bill to go up? Mostly, if you look at the data, capital goods, and then industrial inputs and raw materials. Food remained around between 10 and 14%. That was what we had for most of 2021. Which means now that what goes into consumption is not a major factor in our inputs. Which means then that in the near term, and that is what I think MPC will be paying attention to, in the near term, are we likely to have the import pressure we experienced in 2021 repeated in 2022, 23, 24, 25? And in my own estimation, I don't think so. Because most of what we imported and we're importing are capital goods that will expand our capacity to produce locally. And that now becomes a factor in the rate of inflation, and of course, the rate of growth, and indeed also the rate at which you import. Because you begin to produce locally, that will reduce your dependence on imports. So the final point I'll make there before we now take on other issues is what we call the interest rate differentials. Now, you made reference to inflation. Now, in response to inflation, let me use the US to illustrate this so that viewer can understand this. In the US, when inflationary pressure began to mount because of the fiscal stimulus introduced by the government to counter the problem that COVID-19 brought for the economy. Now, inflation began to go up in the US, but the position of the Federal Reserve, that their central bank, was that the inflationary pressure they were seeing were not permanent in nature. And so they saw no reason, therefore, to normalize monetary policy. But having observed that for well over a year, they began to understand that the inflation in the US was taking a permanent nature that got them at the latest data available that they were now at the position they saw last 40 years ago. So it's understandable that the Federal Reserve will normalize. But how does that affect Nigeria? Because that's again something most analysts point to here. I don't see that affecting Nigeria adversely. Why do I say that? Now, the reason is simple. When you look at the rate differential between, let's say, the Nigerian economy and the US economy, talking about Naira-dollar exchange rate as an illustration, you find that that differential is meant to be the risk premium. So the question then is the risk premium investors look at the differential worthwhile as a price for the risk they are taking for putting their money here? And is the normalization in the US, for example, going to bring an increase in the interest rate there to such level that the differential will be reduced to an extent that will make the risk premium they require here to remain here become so high relatively? So if that is the case, most of them are unlikely to respond to that normalization by taking their monies out from here. The only argument for them to consider that probably will be if the political environment becomes toxic, in the sense that 2022 is a pre-election year. So unless the political environment is toxic, that is only when foreign investors, especially portfolio investors, will want to move their money out, not because of normalization of monetary policy outside there. So let me leave it there for now. Thank you.
Great stuff there, as usual, from Dr. Adedikpe. Now, another two-in-one question. I'm interested in that non-oil sector growth, because we've talked very much about moving away from crude oil proceeds and shift our focus. How sustainable is this, and how well are we doing to strengthen this? Because one way or the other, this will also help us get Forex and help bridge that aspect of foreign exchange, the issues that we've been having around the foreign exchange market. So how sustainable is it, and what are we doing? Are we moving as planned? Because even the intra-African trade that we talk about, trading between African countries, is also something that I think is a welcome development. Now, how well are we doing if we are to strengthen base with the export market?
Fantastic question. Now, you see, my view of this is to start from which are the major sectors that contribute to Nigeria's GDP. And in the last 8 to 9 years, maybe up to 10, I've interrogated the data and established that there are 6 sectors that contribute the most to our GDP in Nigeria: agriculture, trade, ICT, manufacturing, mining and quarrying, and real estate. Among those 6 sectors, they've contributed on the average between 77% and 82% of our GDP in the last 9 to 10 years. So it then means those are the sectors where we create the most value in Nigeria. And so the question is, what is happening there? How much of that can we convert into export? And that brings me to a question. If we really are interested in growing non-oil exports in Nigeria, they must take advantage of what you mentioned now, the African continental free trade agreement that makes African countries borderless when it comes to trade. And happily also, the Afrexim Bank has come up with a product that makes it possible for, let's say, Nigeria and Ghana to trade with each other without having to pass through a third currency like the US dollar, which means the Ghanaian cedi can go for Nigerian naira direct. Okay, so that cuts out a third currency that also adds to the pressure that the exchange, that the currencies of African countries also go through. So now, given that, it means there should be focus in terms of direction, mostly on African countries. And if we are going to do that, what would be a creative way to deal with that? Take every major African country that we want to target as an export market and ask ourselves, what are the top 20 products that those countries import? Where do they import them from? What are the specifications of those items that they import? What then are the chances that Nigerian exports can displace those imports from those non-African countries? So if we look at it that way, then we come back home and ask ourselves, if they relate to agricultural produce, we then ask, is there any incentive that the government can introduce, number one, to rack up production in that particular produce or product, as the case may be, and then how government can provide support for them to successfully sell to those African countries and take advantage of the open borders. Now, that is a way to grow non-oil exports. So it then means if you look at what is happening all around the world, if we truly want to take, let's say, the growth model of a country like Germany, like Japan, and a couple of others, that their economy are wired based on export, it then means you must be deliberate in incentivizing export, so that therefore we take advantage of growing not only the non-oil sector, but the export content and the foreign exchange and its foreign earnings from such ventures. So that way we boost the supply of foreign earnings, as rightly said, but coming through a clearly designed and focused policy on reaching out to those African countries to take advantage of what is available. That's my response to that.
Now, wrapping up, by this time tomorrow, the CBN Governor, of course, will be reeling out his resolutions. In your thoughts, I know it's really not very easy to preempt the resolutions, but we know some of the fundamentals that will shape this. What are you expecting?
Thank you so very much. Now, when questions like this are posed to me, I ask myself, if I were a member of the Monetary Policy Committee, what are the issues that will shape my argument for where I want rates to go? I will say at this point in time, the Nigerian economy is still desperately in need of growth. In which case, focus should be on growth and also how we diversify our foreign earnings. The economy itself is diversified in terms of many sectors contribute to our GDP. No problem with that. But it's our foreign earnings that is not diversified. So if we want to look at those two, then I will say to get growth, I should leave the monetary policy rate at the level where it is. That's number one. In which case, I won't touch MPR. I will leave it at 11.5%. That's what I will recommend to the committee. Then secondly, I will now say, let's look at the banking system. Nigerian banking did very well in 2021 by any standard globally. Okay, the sector grew quite all right, and the sector also did not grow in such a way as to create more of non-performing loans based on the data available so far. So if that is the case, it means we have a banking system that is also growing steadily and still remains attractive to investors. So how do I provide support for that? Yes, I might not necessarily reduce the liquidity ratio requirement because I'm conscious that this is a pre-election year, and so I don't want to create liquidity surfeit, knowing that eventually, as campaigns begin, there's likelihood to have a lot more funds move into the system and circulate. So to that extent, I may not therefore reduce the reserve requirements. So ultimately then, what I expect is that the CBN is likely to leave all rates unchanged and possibly tell us that they are watching closely the developments in the economy, in the financial system, as well as the global economy and developments, especially in countries that are major trading partners of Nigeria.
We'll watch out and see how that plays out. We really appreciate your Monday, you spending your Monday afternoon with us, Dr. Abiodun Adedikpe. He is Chief Consultant, B. Adedikpe Associates Limited. Thank you so much for explaining this and making more sense of what the MPC meeting would, the discussions will be around, and expectations. Do enjoy the rest of your day.
Thank you very much for having me. God bless.